Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to Standard Chartered Money Insights. I am Manish Jaradi, Senior Investment Strategist, and on this episode of the podcast, we'll discuss our latest weekly market view publication titled Europe Calling. Joining me today for this conversation, I'm glad to welcome Abhilash Narayan, Senior Investment Strategist from our Chief Investment Office team. Without further ado, let's kick off today's conversation. Hello, Abhilash. It seems like the stars are finally aligning for Europe.
Thank you, Manish. And absolutely, we are seeing a number of factors aligning together for a stronger rebound in economic recovery in Europe. So, first off is obviously vaccination, and Europe has made huge progress in terms of increasing the vaccination rate in the past couple of months. So, right now, actually, if you look at Euro area, nearly 50% of population has been given at least one dose of vaccine, which is sharply up from 28% number about a month back. And at this rate, we think that about 70% of the population would be vaccinated by July. Now, this obviously means that the authorities would be able to reopen the economy progressively and remove travel restrictions and maybe even welcome international tourists later this year. Uh, all of this should mean that consumption and services sector should see a strong rebound in the coming few months. The other factor which is supportive for euro area recovery is the fact that the 750 billion euro European Recovery Fund is set to start dispersal in second half of this year, which should provide additional fiscal thrust to euro area growth.
A positive macro backdrop means European equities could be supported, right?
Absolutely. And in fact, we turned overweight or positive on euro area equities just a few weeks back. Now, like you mentioned, the economic backdrop is improving for euro area, and we are actually starting to see that filter through to fundamentals for European equities. So, if we start with earnings, if you look at the earnings revision index for euro area equities, it is the highest that we have seen in the last 10 years. If you look at the absolute earnings growth that is expected in Europe and UK, it is the highest, relative to other regions, be it US or emerging markets. Moving on to valuations, we believe that valuations for euro area equities are cheap on a relative basis. So right now, euro area equities are trading at a PE ratio of 16.5 times, and they stand as 10 to 12% cheap versus global equities. And lastly, if we look at investor positioning, from our perspective, the investor positioning in euro area equities is quite light. And as the economic growth momentum picks up, we think we could see strong fund inflows coming into Europe. And that, again, should be something which helps euro area equities outperform global equities going forward.
Very interesting. Since we are on equities, let me ask you, which sectors do we prefer in Europe?
Thanks, Manish. Right now, we prefer three sectors, namely financials, technology, and industrial sector. Getting the easy sector out of the way, obviously, industrial sector should benefit from the cyclical recovery that we just talked about. Moving on to financials, we have seen an increase in long-term bond yields in euro area, and the steeper yield curve as a result of higher long-term bond yields should mean that the interest income that banks generate is likely to improve going forward. Additionally, we expect ECB to ease the current dividend restrictions that are placed on euro area banks. So overall, when we put together stronger earnings and resumption of dividends, we think that there's a very high chance that euro area, banks and financials outperform the broader market. Last but not the least, we like technology sector in euro area because it is dominated by semiconductor industry. And over the past few months, we have all probably come across the news that the global economy is facing a semiconductor shortage. And we think that the technology sector in Euro area is poised to benefit from the strong demand.
So, with a strong macro backdrop and positive outlook on equities, what does all this mean for the euro and the pound?
At a headline level, we are bullish on both the euro and the pound. And we think it's a combination of both push and pull factors for both these currencies. So, first off, looking at the broad factor, we think that in the next few months, we could see the next wave of US dollar weakness. And that should obviously help both the euro and the pound strengthen. But looking at Europe specific factors, we think that the economic recovery that we just talked about is something that is on a standalone basis would argue for a stronger euro as well. The other thing that we are watching out for is the ECB meeting on 10th June. And right now, markets are not expecting any change in policy. But in case ECB indicates that it is less accommodative than what markets are expecting it to be, then it could be a positive near-term surprise for the euro. Moving on to the pound, we think that Bank of England is likely nearer to rate hikes than any other central bank in the world as QE bond buying approaches a cap. And at the same time, we have seen house prices rise in UK, which is fueling some concerns about higher inflation. So overall, we think that the pound has a strong upside potential in the near term as risk sentiment improves and the fact that the positioning is already relatively light.
Thank you, Abhilash. That's all for this episode of Standard Chartered Money Insights. Thank you for joining us. If you would like to learn more or read our publications, please visit our website sc.com under Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get the podcast. Once again, thank you for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.